Interesting learning module. We're going to be bringing together everything that we've been learning in the financial analysis section, financial statement analysis section. And we'll just have a quick recap of the financial analysis process, which we discussed in the start of the financial statement analysis section. We'll get into the tools and techniques. A lot of this material is going to be repetition of what you've seen in all the different learning modules. For example, we saw common size analysis for both balance sheet and income statement in their respective learning modules. So we'll be looking at that again. How we use that common size for doing cross-sectional or trend analysis, and the relationship among your different financial statements. We will talk about using graphs and regression analysis. Then we will look at the categories of common ratios, their interpretation and their context. And this is again material that you have seen before, such as activity ratios, liquidity ratios, and solvency and profitability ratios. Then we will move to having an integrated analysis where we bring all of it together. And of course, my personal favorite, the DuPont analysis. This is going to be something new for you. This is something that we have not seen so far in this material that we have been covering together. So this is going to be something new, very, very interesting. And then finally, industry specific, right? We're going to look at certain industry verticals which are better suited for some ratios and others which are more suited for others. And then finally, we will get into model building and forecasting, that how does an analyst actually use all of this in a practical setting. Right, let's get started with the introduction. So, of course, financial analysis is a very useful tool in evaluating the company's performance and what is expected in the future. So what are the trends? How does an analyst go about doing this? What is the source of their analysis, or where do they get the data from? Well, of course, the main is the company reports and financial statements, which are, of course, usually part of your company reports. But then there are other things such as management discussion and analysis, which are also included in your filings. So the balance sheet, the income statement, the cash flow statement, all of that, then all the subjective information which is being shared in the management discussion and analysis, and any other information the company is sharing. And what makes a really good analyst is that you take outside information as well, right? And then you come to valid conclusions. And you know something, if you've already covered the ethics portion, then you've probably studied something called the Mosaic theory, right? And what the Mosaic theory is that you can take non-public information, which is non-material. Now, material is anything which is, of course, having certain economic significance that a decision maker, which is having an economic interest in a company, would like to know. And you can't use non-public material information, otherwise that is unethical and illegal as well, right? But you can use information which is private or non-public, which is non-material, with public material information, right? You can come up with a theory and invest in a company and actually have fantastic results. So this is where the analyst has to be capable of using the public material information that comes in with the financial statements, along with other information that might be public, that might be non-public, might be non-material, non-public, right? And then you bring it all together and make some very, very interesting conclusions. Now, let's say I give you an example that there is a company which is coming up with a drug, right? Which is coming up with let's say a drug for a certain disease. Now, you take all the information from the company, which is their public disclosure and which is material, and then you combine it with certain information which is, let's say, industry trends for that particular disease. And if that disease is going up, right, then naturally, if this company is coming up with that with a drug, with a medicine for that disease, naturally it will be very, very profitable for that company in the future, assuming that they get the approval. So then again, for the approval, you might take some other economic or industry trends that you can say. So you can see surveys of physicians that are in that particular area of expertise, that how do they feel about this new drug, and then you can try and estimate that what is the probability that this company will get an approval. The important point for you to understand is that you must know what is the purpose of you doing this financial analysis, right? Going into the analysis, you need to know what is the purpose. Let me give you another example. Let's say we feel that internet penetration is increasing all over the world, right? And we feel that in like places like Africa, there's going to be a boom of e-commerce because, well, they've not had it that much previously. And now we just want to know that which companies are going to do better, right? Is it going to be Amazon that takes a bigger share over there, or is it going to be a company like Alibaba that takes a bigger share over there? So as an analyst, you have a certain high level perspective, right? And some economic trend, and then you want to go in and start doing some financial analysis and then pick out a company which you feel might benefit from that high level trend. So whatever the case might be, you really need to know your purpose before you get into the analysis. And this is something that we talked about right in the beginning of financial statement analysis, that as a first step, right, we talked about 6 steps, and I'll just show that again to you in case you've forgotten that whole process. But the first step was definitely knowing why you're doing this analysis. Once you know why you're doing it, then you can get into the nitty-gritties of what techniques you want to use, right? And they will be different depending on the purpose. So if you're doing a long-term investment, a different level of detail will be required versus if you're doing a short-term investment, especially if that short-term is in fixed income, whereas the long-term is in equities. So a completely different type of analysis will be required. So as promised, this is just to recap that what was the financial analysis framework that we had talked about at the beginning of our FSA discussions, financial statement analysis. And these were the 6 steps, right? Where first you define the purpose and context of why you're doing it. You collect the data, and then you process the data and you analyze and interpret that data. Now, these 2 parts are the focus of this particular learning module that we're doing right now, right? So this is the focus now. And then, of course, once you've processed the data and analyzed it, then you communicate and you keep doing that follow-up process, because this is an iterative process. You have to update your analysis and assumptions. So now, as discussed, it's the 3rd and 4th stages or steps of the financial analysis framework which this learning module focuses on, right? So how to adjust the financial statements to compute your ratios, produce graphs, forecasts, and then how to analyze all that to arrive at a conclusion. Now, there's few things I want to talk about over here, and we will talk about it again in the following slides. But I just want to give you sort of a heads up so that you know what to expect. See, practically speaking, do we really compute those ratios ourselves? Well, yes and no, depends on the context. You can use service providers like Bloomberg or Thomson Reuters, right, to calculate those ratios for you. But again, what's really important is that you remember our discussion on Pepsi and Coke with respect to different inventory valuation principles, such as first in, first out, and last in, first out. So again, I mean, if one is following one and the other one is following the other, and if you're going to compute your ratios without adjustments, there is just not going to be an apple-to-apple comparison. So what you might need to do is you might either need to manually do it, right? Or what would else otherwise be suggested is that you take both the ratios from one provider whether that is Thomson Reuters or Bloomberg or whichever one. But the point being that consistency is important, right? When you're doing this type of analysis, right? So that is just something I wanted to emphasize on. So the whole point is, one more thing that I want to emphasize on when we talk about arriving at a conclusion is that the difference between computation and analysis is that computing the ratios is only half the work, and that you can even get from third parties. As an analyst, of course, your real value addition comes in with what is the conclusion you're going to derive, or what is the conclusion you're going to arrive at looking at those ratios, right? So that is the main thing, that you have to distinguish between computation and analysis, right? It's an effective analysis is not just coming up with that data and just presenting it in very nice tables and graphs. You can even get that from third parties. The whole point is, what do you make of that data, right? How do you determine the reasons behind the performance? And that is what differentiates a good analyst from a not so good one. That how do you sort of analyze those trends, right? See what's underneath that data, and then come up with your conclusions and recommendations. So again, of course, all of it starts off with the purpose, right? So if you're giving a report, let's say you're giving a report, naturally you'll start off with what was the purpose of you doing this analysis. And then you'll give the context, the overall economic environment, financial, other infrastructure, legal, regulatory. So what we usually like to call PESTLE, right? Political, economic, social, technological, legal, and environmental factors. You can get into the analysis of management, and then that is not only with respect to their core performance for shareholders, right, or bondholders, but for all stakeholders, and that's where your corporate governance comes in. And this is something we've discussed in earlier videos as well, right? And if not, you are definitely going to see a lot more about this in your corporate issuers section if you haven't already seen that one yet. Right. And then, of course, this is the core of this whole report, where you assess the actual financial and operational data and whatever assumptions there are. And finally, you get to your conclusions and recommendations and whatever were the limitations of the analysis and risk. And there are quite a lot of limitations, and we will be getting into that. Right. So what are all the tools that you have? Of course, ratios, but they have their limitations, which we will be talking about very soon. Common size analysis is a very, very good tool, right? It's similar to ratios, and we will be covering that as well. This common size analysis is very good for comparing companies within the same industry of different sizes, right? Then graphs, regression analysis, also very, very good, but this is going to be covered in more detail at level 2. And well, going forward, the data science and big data world that we are in, it's becoming more and more important, all this predictive analytics. So get ready for that for level 2. And that, of course, is not just important for your CFA, but it is becoming a lot more important in real world analytical use. So that's very good. I personally, of course, use it a lot, and it is very, very helpful. Anyways, moving on. So what you have to do is that the whole point is you need to come up with a meaningful comparison of the company's performance. And then again, I mean, you need to make sure that whatever adjustments need to be done are done. And, a simple example is LIFO versus FIFO. So if you're comparing one company which has LIFO and the other one has FIFO, you need to make adjustments for that. Or if you're, let's say, thinking of investing in Apple versus Samsung, right? And one is IFRS and the other one is US GAAP, then again, you need to make a lot of adjustments for that. Or another example, let's say you're doing Pepsi and Coke, right? And Pepsi also has a business of snacks like Lay's, right? So again, I mean, if you're just going to take the ratios right on top and not adjust for these separate businesses that are there, then it's not going to be a very apple to apple comparison, Right. So we're going to be looking at all of that and how we can go about doing cross-sectional analysis, which is at a given point in time, like a snapshot, right? Or over time, which is going to be time series. And again, some very, very interesting discussion in level 2 on that. So anyhow, let's get into ratio analysis now. Now, ratio analysis is just any kind of a fraction that you're calculating, right? You put in net income in the numerator and you put in sales in the denominator, and you've got your net profit ratio. Or you could do this for so many other type of analysis perspectives, and we're going to be looking at all of them. And that is actually a very, very nice way to do your analysis, because it's very, very straightforward, right? But the complexity or the limitations come in where you start to interpret them, because that could be subjective, right? Let's say if I'm comparing Pepsi and Coke with respect to their profitability, but in Pepsi I know there is that business of chips or snacks as well, which is Lay's, whereas Coke might not have that. So I mean, it's kind of unfair comparing the ratio of these two companies, because we think they're in the same industry, but actually they're not, because there's some other businesses going on within one of those companies. So that's something we have to sort of keep in mind, that ratios are good, very straightforward to calculate, right? They give you very, very good information, and also help you come up with future projections, because you can just take that as a percentage and say, okay, if the sales will grow, then the profitability will grow in that certain ratio, in that percentage. But then again, you have to keep the limitations in mind as well. And we will talk about the limitations in detail as well. So what do all these ratios help you to evaluate? Well, you've got your efficiency ratios, right? Also called activity ratios. They really try to see how efficiently a company is managing their supply chain, right? In terms of what is the level of inventory are they maintaining too much, right? Compared to certain Japanese companies like Toyota are very, very efficient. They've got this just in time inventory going on, right? Which is, they don't even keep any extra inventory. When they need to order it, that's when they tell the supplier, and the supplier directly delivers it. So these type of ratio analysis help us find out how efficiently a company is managing its operations. Financial flexibility, in terms of, are they trying to really lower their interest cost and risk running out of cash by keeping very, very little cash idle, right? Trying to invest most of the cash they have and not taking unnecessary amounts of loans, which is good because you save interest costs, but at the same time you might run out of cash. So this is something we're going to be looking at, right, in terms of both short term and long term. So that's like solvency, which is a long term situation, and liquidity is short term. So are they expected to have enough cash in the short term? That's their liquidity situation, and we look at liquidity ratios. And in terms of their debt to equity ratio, that how much of a percentage of their assets is financed by debt and how much is financed by equity. So if it's too much debt, then that's bad for their solvency, right? Because they might go bankrupt if they are unable to sustain business. Then we'll be looking at profitability ratios, and that really helps us judge the management's ability to churn out a decent profit, right? And not just in terms of accruals, but also the cash flow, right? So we'll be looking at cash flow as well, because at the end of the day, valuations are and should always be based on cash flows. Right. The ratios really help us to do some trend analysis as well, right? Has the profit been increasing? Has the profit been decreasing? Is money getting stuck up in like the working capital, like account receivable or inventory, more than the cash that the company is generating? So is the company kind of running out of cash? What's happening with the long-term fixed assets, right? Are they taking up too much cash because their depreciation is now, the majority of their life as assets is over. So, it really helps you get a good understanding of where the company is in its lifestyle, in its life cycle, and what type of performance it is giving you, right? And especially you can compare that performance to its peers or its companies in the same industry. So you get a good idea about how well is the health of this company overall. So that's fantastic, right? I mean, just by looking at a few numbers, you can really get to know a lot about a company just by looking at 10, 15 different ratios. But then again, there are limitations, right? There are limitations because every company is different, right? So that's where the homogeneous or heterogeneous discussion comes in. Homogeneous meaning same, and heterogeneous meaning different, right? And companies may have divisions that operate in a variety of industries. And the classic example here is Pepsi with its Lay's division, which Coke might not be having, right? And then Pepsi has God knows what else. They have investments in so many other fast food businesses. So, and Coke might have a lot of other things as well. So, I mean, that's why it gets difficult to compare industry ratios. So you have to be aware of these limitations of ratio analysis. I mean, it's a very fantastic thing, but at the same time, you really need to make the adjustments. Right? You as an analyst need to use your judgment when you're interpreting these ratios. And it really depends, number one, on the adjustment that you need to do. And even after making the adjustment, you have to understand that it has to be within the industry. I mean, you cannot compare Pepsi with something like Heineken, right? Or Budweiser, because they are in completely different industries. I mean, I know they're both beverage, but it's a completely different type of beverage. So you really need to look at the ratio in perspective, in context of its wider relevant universe. Definitely, accounting standards make a difference, right? So again, with the Apple and Samsung example, that if one is following IFRS and the other one is following US GAAP, you will need to make adjustments, right? And even if both are following US GAAP, but one is doing LIFO and FIFO, then again, you need to make adjustments. Even depreciation methods can make a big impact, because if somebody is doing accelerated, their depreciation will be much higher in earlier periods, which means their profit will be less compared to another company which is doing straight line. So you, of course, are now at the last stage of your financial statement analysis. So you know all about your LIFO, FIFO, and the different depreciation methods. And again, with this discussion that we already had, that the nature of the company's business can be different, or at least they can have different business divisions. So your results can be inconsistent, especially if you're doing short-term analysis for it, and you need to be aware of this. Now, moving on to sources. And this is something I already told you about, that you could be getting this data from third party. And what is the important thing over here to understand is consistency, right? So, I mean, if you are getting it from a different third party instead of manually calculating it yourself, the important thing is that you have to be consistent about it, that you should take data from the same source for all of your analysis. Don't do that you take data for Pepsi from one side and you take data from Coke for the other side. That, of course, makes absolutely no sense. Right, moving on to common size analysis, and this is something we've already covered in your respective learning modules for balance sheet and income statement, but never mind. Nevertheless, let's have a look again, because this is such an interesting area anyways, that how do you go about bringing financial statements into a situation where you can actually compare them on an apple to apple basis, right? Because obviously, if you're comparing a big company with a small one, and let's say we talk about Tesla, and then there's this new electric vehicle company, some of you might know about it, called Lucid, right? So, I mean, they're both electric vehicles, they're in the same industry, but Tesla is probably 10 times or 100 times the size of Lucid. So how are you going to compare them? So what you need to do is you need to bring them to a common size, which means you have to see everything with in the perspective of a certain item which is relevant to that company. So for example, if we're doing income statement, we will say, okay, what is the revenue of Tesla, right? And let's say we want to compare their net profit. So net income or profit, right? What we will do is we will see it as a percentage of revenue. And similarly, we will see the net income of Lucid as a percentage of its revenue, right? So it's very similar to ratio analysis, where basically what you're doing is comparing your profitability ratio, right? So it's very similar to that, but here the difference is that we're actually going through each and every item on that financial statement. So for example, if we talk about the balance sheet, so here we will take it as a percentage of total assets, right? So total assets of Tesla, and then we can see, let's say maybe what percentage is the account receivable of Tesla as a percentage of their total assets versus what percentage is accounts receivable as a percentage of your total asset of Lucid. So we get an understanding that, okay, how much credit or sort of receivable each of those businesses having as a percentage of their respective revenues, right? So this is good. This can be done in a vertical way or in a horizontal way. Now, what we just talked about, where we said for the income statement, everything is taken as a percentage of revenue, that is vertical, because what you do is you have your sales, right? And then that's 100%, and everything else is going to be in that. So therefore vertical, because it's just like that. And balance sheet as well, right? You'll have your total assets. Well, they actually come down here, right? Total assets, and that will be 100%. And all the other items such as your cash, inventory, account receivable, etc., property, plant and equipment in the non-current assets. So this is your current assets, this is your non-current assets, right? They will all be shown as a percentage of your total assets, and that is vertical as well, because it's just in a vertical line. Now horizontal basically means that instead of making your one period data 100% and seeing all the data within that period, what you basically do is that you make it a base year. So let's say this is 2020, right? And we make 2020 the base year, and let's say the cash was 10%, right, over here. So now in 2021, what we will say is that, okay, if cash has gone up, so then with respect to if we take the 2020 cash as 100%, has it gone up in terms of 10% plus or 10% minus, right? So if it has gone 10% plus, we will show it as 110%. And if it has come down, we will show it as 90%. So it's not really linked to the total assets of that year. No, it's linked, each item is linked to its predecessor, right, from the base year. So this is basically your horizontal analysis, which is, by the way, also called trend analysis. And this helps you see where the trend is going. And of course, we're going to be discussing all of this in detail now. So that was just a high-level introduction for you. And now let's go through all the details. So vertical analysis, as we talked about, in terms of balance sheet, everything will be seen as a percentage of total assets, right? So each and every separate balance sheet account as a percentage of your total assets. And you can see that over here for Everest, where you've got your total assets being 100%. And of course, you know, based on the accounting equation, that total assets will always equal liability plus equity, right? So that will, of course, be 100% as well. And each of these is shown as a percentage. So you can see over here that inventory is little bit going up, right? Accounts receivable is coming down heavily. That's good, right? Because they're probably being able to pull money from their clients. And yeah, so that's what's going on in this common size vertical balance sheet for Everest. Now, if you're doing horizontal, here you're going to basically be locking in a base year and then see every item in relation to that base year. And let me show you. So let's say 2014 is the base year, right? So what you do is you make 2014 100%, each item separately, and then you see has it gone up or has it come down. So clearly you can see cash has come down 10%, whereas inventory has gone up 10%, right? And you can even see that in the numbers that cash is going down, whereas inventory is going up. So again, with that same data, so you can see that cash has decreased 10%, whereas inventory has increased 10%. So this is very good. It helps you highlight any structural changes that may be going on in the business, that maybe they have started to maintain more inventory, or maybe their sales are slowing down, right? That could be one of the reasons why inventory is piling up. Right, now with the income statement common size, starting with the vertical, and here it's the same for vertical and horizontal, is that you always take it as a percentage of revenue. And similarly with the horizontal, that you can do it for a base year as well, and that can help you with the trend analysis. So anyways, let's have a look at the vertical common size income statement. Everything is taken as a percentage of your total revenue. And let's see, let's try and do some analysis over here. So salaries are going up. Well, we need to investigate that, right? Admin expenses are coming down, but not that much. But this increase in salary is quite large. Rent expense is the same. And this drop in your earnings is probably because of the increase in salary. So we really need to investigate this, that why the salaries have gone up so much as a percentage of revenue. So it's highly likely that, okay, maybe the revenue is going up, but as a percentage of revenue, it has gone up, right? Interest is the same, and depreciation is the same. So everything else looks somewhat okay, but of course, the increase in salaries and employee benefits is quite large. Okay, cross-sectional trend analysis and relationships in financial statements. So this is interesting because what we're going to be talking about over here is looking at that data over a longer period of time, right? So if you look at what was going on over here, this is 2014 and this is 2015. Okay, so it's flowing this way, so it has decreased, whereas account receivable has gone up. So I'm sorry, I actually read it this way, but it's 2014 to 15. So account receivable hasn't gone down, it has actually gone up. So my apologies, I thought that it was going down. So obviously you have to be careful with how the numbers, how the years are there in the columns. So clearly here the account receivable is going up, which is not a good thing, because your money is getting stuck up in loans or in credit that you're providing to your customers, right? So this is not good. Right, cross-sectional, it's as at any given point in time, and this is for one company. You can compare it to another company, right? So let's say for any given point in time, what percentage of your total assets are in account receivable, right? What is account receivable as a percentage of your total asset? And you can compare that across two companies and see or you can even compare one company to the industry average and see if they have too much of money stuck up in receivables, right? So let's have a look over here. We are comparing Everest with Alps. And what should we compare? Let's say we are talking about receivables. So account receivable is 5.2% for Alps, whereas it's 7.5% for Everest. So that's alarming, right? Because Alps has a lower one than Everest. But then what I would do is probably I would say, okay, what's the industry average, right? And then if the industry average is, let's say, somewhere around 5%, then I would be worried with this 7.5. So how does your trend analysis for your common size horizontal analysis give you insight? It really helps you see what's going on inside that company, right? If accounts receivable is consistently going up year to year as a percentage, that you've got 4%, then you've got 5, and then 7, and then 8, so then you feel that there is something definitely wrong in that company. And let me show you a case in point. So, you know what I would request you, what you should do is that just pause the video here, right? Pause the video here and think about try to identify some potential issues in this company. The revenue is going up 15%, but the receivables are going up 40%, right? Inventory is going up 60%. So what do you think? And let me then just show you what I think as well. So please pause the video and try to analyze this. Okay, so hopefully you were able to catch that this business is showing a growth of 15% in its revenue. But first of all, the cash is not just there, right? I mean, the operating cash flow is falling. Now, even the income is rising, right? Revenue is rising, income is rising, but cash is not coming in. So that is a red flag. And why that is happening, why is the cash not coming in, is because it's getting stuck up in inventory and receivables. Now, is that a good thing? Well, you need to investigate, right? I mean, why are so many of the sales that are being done on credit? Why they have not been able to realize the cash yet, right? All those sales are based on your accrual accounting, where you're recognizing the revenue, but the cash is just not coming in. So if there is some decent justification for that, then I guess it's okay, but you really need to investigate and find out that why so much of money, cash, is getting stuck up in receivables, firstly, and secondly, why are they just increasing the inventory on hand, right? Now, I used to work for this company many years ago, and I remember that a similar situation was happening for them, because what they were doing was they got into a new business model where they used to first sell this equipment on cash, right? But then they explored a new way of leasing, right, where they found that the customers were much happier. So what they were doing was they were just giving out these they was selling that equipment on leases, and naturally a lot of the receivables were being recorded, right? And because they were growing, so they had to invest in inventory as well. So this can happen, right? This is, you can say, it's like a growing pain for the company. But then as an analyst, you need to dig deeper and make sure that is it really because of growth, or is it because of poor inventory and receivables management, right? So very, very interesting. And, it's really fun to actually apply this in practice. Anyways, let's take a break here. You also should take a break, and then let's come back and then get into graphs and regression analysis.